We're here to talk about Silicon Valley real estate market conditions as of November the 2nd. I'm not going to go into all of them, but these are chapters you can jump to get to the section you're most interested in. I'm Richard Calhoun, Creekside Realty, working with buyers and sellers here in Silicon Valley. Here's the first data chart. What you're looking at here in the purple is the total inventory. So this is active inventory. Notice the rapid drop off. This is not the drop off at the end of the year. This is compared to normal. So if we were having a normal amount of drop off, this line would have been flat at about 90%. The fact that we've gone from 90% of the inventory you'd expect to 84% of the inventory you'd expect means that the inventory dropped by 6% of the inventory greater than it normally does from last week to this week. If it was 100% of normal, it'd be horizontal on the black line up here at 100%. If it's horizontal, it's not changing the same as it typically does based on the past 10-year median, such as the offers is here. It's pretty flat, so the number of offers is roughly the same. When it's dropping dramatically like the inventory did, that means that the inventory is dropping more rapidly than it typically drops or increases. If we were in an increasing marketplace, it would mean it increased less than normal. We are at a time of the year when the market is decreasing, so this means it decreased more than it normally decreases. Moving on and looking at the number of offers is relatively flat from last week to this week. We're sitting there at about 83%. I would expect a drop in offers for next week. Not as dramatic as a drop in inventory, but I would expect this to drop down somewhat significantly, probably under 80% would be my projection. There's no way to know until we actually get the data. Then you look at days of unsold inventory, that's the speed. All three of these indicators or metrics are done independently. In other words, the median number of days of unsold inventory could be in a different year than the median number of active listings, and that could be in a different year than the median number of offers. And that does in fact tend to be the case, which is why this is not much closer to 100%. You would expect with the inventory and the offers at roughly the same level, percentage level, you would expect the DUI to be much closer to 100%. That's because they're happening in different years and each one is done independently. Now what we're doing on this slide in the next group of slides is we're comparing where the market normally is, which is this gray line up here, to where the market actually is on the purple line. And then the red line is the least amount of inventory you'd expect based on the past 10 years. And I define that to be the 10th percentile of the past 10 years. And then the blue line is the most inventory you'd expect, and it's not the most in the least, and I should change my index, but it's favoring the buyer up here in the blue, a cool marketplace, favoring the seller in red hot seller's marketplace down here on the red line. And that's what the consistent pattern is. Red is for a hot seller's marketplace, blue is for a cool buyer's marketplace. You can see your inventory is below where you'd expect it to be at this time of the year, which is why the inventory was, I thought, what was it, 83% or something like that on the previous slide, but it's falling at about the same rate. Now, based on the previous slide, we know it's actually falling at a greater rate. What it looks like is that we're basically a weak shift in the timeline is what it appears to me to be more than anything. Moving on and looking at the ratio compared to normal, you can see that you're down here, I think I said 83. It looks like it's probably close to 84 or 85% of normal. But you can see there you were up here at basically 90% of normal just last week. So a fairly significant drop. That means that the purple line here dropped more than it typically does. It looks like last week's data was here and it dropped to here. So normally maybe it would have dropped to about there. So the drop for this in inventory has been this last week. Moving on and doing the same thing with offers, you can see offers did drop a little bit, but we're still up here somewhere around 2,150 offers. You can see that that is less offers than you'd expect because if you were getting the normal number of offers, you'd be vertically straight up, and that would be about 2,500 offers, it looks like. And it's hard to go all straight up on this type of scale. Maybe it'd be down here at 2,400, but it's something of that magnitude. And you're on the blue side of the gray line, which means you have less number of offers than you typically do. One thing I want to point out is I look at offers accepted, not pending transactions. What's the difference? I look at offers that were accepted in the past 5 weeks that are still valid offers or closed transactions. Pending, look at the escrows that are currently in escrow. Now, I have noticed a few other people that collect data have come up with yet other definitions, so you have to understand what is being used. The problem with using those that are in escrow, if a transaction is in escrow for 9 weeks versus 3 weeks, it counts as 3 transactions compared to the 3-week property. That's why I look at the number of offers. Each transaction, whether it closes quickly or long, gives the same weight to the statistics. Here's the offers accepted compared to normal. You can see we were running somewhere down around 75% of normal level of offers. We shot up and then we were leveling off at somewhere around 83% of the normal. I would expect that based on larger than normal drop in active inventory, I would expect this drop in offers accepted next week to be bigger than it normally is. So I'd expect it to drop down to 80% or possibly lower. Here's looking at days unsold inventory. And again, you have the data going all the way back to 2014. You come up on the condensed horizontal date axis all the way through January 1st of 2023. Starting in 2023, you have an expanded x-axis, a horizontal axis, and that's so you can see the trends bigger. You can see the global pattern is the same year after year, which is why I do everything on a weekly basis. And then you can see the pattern that you should be expecting, and the gray line really gives you that pattern because that's a 10-year median, and then you have the current year data. You can see that the speed of the marketplace is actually below the gray line. So even though we're having low inventory and low offers, we're actually turning those properties over at a faster rate because there's less of each. And there's a greater lack of active listings, which gives you the shortage on the red side, than there is a lack of offers. Here's compared to typical. You can see that we were actually a little bit slower than normal for a good part of the year, and now we're sped up and we're faster than normal. Not significantly faster. For the buyer on the street and the seller on the street, I would say that they would say that this is pretty much a typical year. And do keep in mind, this is Silicon Valley as a whole. All of Santa Clara, San Mateo, and Alameda counties, each micro market area, which there's 20 of them, can be performing differently than the valley as a whole. Here's the marketing time. This is simply how long does it take the sellers to get that offer in the door. And I look at the 75th percentile because half the listings typically sell at whatever time frame the agent and the seller are willing to look at offers. So that wouldn't give you data. Even the 75th percentile, you can see the step function in the red line here pretty significantly. And even in the purple line, you can sort of pick up a little bit of a step function in the data. You want to get rid of that step function. You want your data lines to be nice, smooth lines. And I am actually thinking about increasing the 75th percentile to 80 or 85th. And I just haven't decided which number I like. And I may pick some oddball number like 84th percentile because I'm looking at the data. I want the number to be as low as possible to include as much of the market as possible with eliminating the step functions. And that's time-consuming process. But anyway, back to what we're looking at here. Your marketing time is essentially right on the gray line. So sellers are marketing time that they're experiencing here in Silicon Valley is completely normal. And here you can see it blown out a little bit. And you can see that it's a little bit on the fast side at about 96% of where it normally is, but pretty close to normal. You can see it was a little bit longer over the summer. What triggered this slowdown that we had, which was fairly apparent, is unclear. I don't really have a good explanation. The explanation a lot of other people are sharing was just the uncertainty of the buyer broker agreement introductions that happened prior to August 17th of this year. Here is looking at price reductions, and this is what I would call a very tight metric. And because it's a very tight metric, I'm only looking at 10% of the marketplace that's taking the largest price reductions. And that's because sellers and their agents do a lot of homework and price the property where they expect it to sell. And therefore, very few sellers take price reductions. Typically less than 17.5% of the sellers are taking price reductions. And I only look at 17.5% of the marketplace. For this particular data set, I'm only looking at 10%. Because if you add in the 85% or the 82.5% of the sellers that are never going to take a price reduction, you're just adding a whole bunch of zeros into your data and you make it a smaller number. This way you have some fluctuations. At 88%, and this is actually closer to 87% down here, that's saying that 13% of the sellers that are on the market took price reduction prior to getting their offer accepted. And here you can see it's slightly higher than normal, but not significantly higher, about 10%, 12% higher than normal. And it's been running higher than normal basically all year, somewhere between 10 and 20% more than price reductions than normal. And do keep in mind that means that 10% of the sellers are doing price reductions, a 20% increase would only be 12%. So it's still a very small number. Here's the average. So this is bringing us back so people can say I'm not really playing with numbers. And here you can see the average price reduction is only just a hair over 1%. And that's why you have to really blow out the scale from here. This would be 0% price reductions, 1% price reductions all the way down here, 2% price reductions all the way down to here. And you can see that even in a hot marketplace, as indicated by the red line, there are sellers are doing price reductions. They're fairly small. They're less than 0.5%, less than 0.4%, but it's still taking a price reduction. So you can follow it and see the pattern. This pattern that you see every year, the gray line, You come in right after the first year, very few price reductions. You get into second quarter and the number of price reductions start increasing all the way through halfway through fourth quarter. And that's because the listings coming on in the latter half of fourth quarter are motivated sellers, so they're taking less price reductions. At the first of the year, you repeat the pattern and getting less and less price reductions as you get to the end of first quarter. Here's looking at those price reductions versus typical. This is 100%. I plotted it as a negative because sellers normally are taking a negative price reduction. Looking at the frequency of price reductions, this is just how common are price reductions. And you can see that the purple line has been right on the normal line compared to the frequency. That's how common they are. And you can see just going right into the end of third quarter, beginning of fourth quarter, there was a bit of an increase, but we're now following the normal pattern. So that it was completely normal. And then right at the end of third quarter, beginning of fourth quarter, the frequency of price adjustments became less. They reduced. They were up here at 17%. They got down to 15%, and they're back up to 17%. But the normal number is up, would normally have increased from that 17% up to about 18% during that same time frame. So you're still below the gray line. Here is looking at the frequency compared to normal. So if it's having a normal marketplace, you'd be right on the gray line. So you can see all year it bounced around the normal level right up until the end of that third quarter, and then it dropped. So we're having fewer price reductions than normal. Now on this scale, it looks like about 87% of the normal price reductions that you have. And again, this is the frequency compared to normal. This is the magnitude of overbidding. So now we're flipping over and seeing what buyers are doing to try to get their offer accepted. It sort of measures the competitiveness of the marketplace. And you can see that halfway through third quarter, the buyer said the market's getting more competitive than it normally is, because normally the amount of overbidding decreases. And basically this year it's been basically flat. It's pulling away from the gray line. You know, it's not, the magnitude of overbidding isn't increasing or changing significantly because it's been just below 3.5% that whole time, but normally it drops, and therefore the amount of overbidding is increasing compared to normal. And here you can see that increase compared to normal. You can see that we increasing a little bit higher than normal. This was that summer slowdown, and now you've been regaining and increasing more than normal. This is the frequency of overbidding. How common is overbidding? You can see we were basically at the normal level of overbidding. You had a little bit more overbidding basically in second quarter, and now you're having more overbidding in fourth quarter. And this is just how common, not the magnitude. But on the previous slide, it was magnitude. So not only is the magnitude of overbidding higher than it normally is, the frequency of that overbidding is more than it normally does. And here you can see the increase was basically slightly higher than 100%. I'd call it maybe 105% most of this year. And then basically right at the change of the quarter going into fourth quarter, which would be October 1st, the amount of overbidding, the frequency of overbidding has been increasing fairly significantly. And now there's 10% more overbidding than there normally is. And keep in mind, the overbidding is somewhere around 70%. So 10% of 70% is a 7% increase in the frequency of that overbidding. Here's your long-term appreciation, shown by the blue upslope straight line. The actual line is on the purple. This is on logarithmic paper. You can see that we started the year at 1.4 million for a median for Silicon Valley. We shot up here to about 1.8, maybe 1.775. Then we came back down to about 1575, and now we're back up to 1.6. If you look at this graph long term, you'll see there's a downturn right at the end of every year, and there's an oversurge sometime typically in second quarter. And that's a fairly consistent pattern. If you're a buyer, when you don't want to be buying, is in the second quarter because you're paying at the peak price. Where that peak is going to happen varies every year. If you're a buyer, you want to buy very early in first quarter, or preferably the end of the previous fourth quarter. But the problem with that is there's very little inventory to choose from. If you're selective in the properties you want, you may not be able to find the property you're looking for. Here's the payments, the most expensive 90 percentile up here. And this would be for all Silicon Valley. And it would be extremely rare for someone to have a $27,000 a month mortgage payment because this is based on an 80% loan. And a lot of lenders, when you're talking about expensive homes in the 90 percentile homes, somewhere around $4 or $5 million, I would guess, they typically won't do an 80% loan. The typical home, the monthly payment's down here. I would expect an increase like you're seeing on the low end and an increase like you're seeing on the high end. Here, we're now looking at just the last 14 weeks of the 5 key indexes. The overbid is in here more as a curiosity versus a key. So it's 5 key metrics plus overbidding. The reason overbidding isn't a key metric is it's lagging by the length of escrow. You have the raw count of inventory. You started off the moving quarter at 2,400. You're now just under 2,300. But at the same time, even though your inventory went down, you went from 77% of the expected inventory to 84% of the inventory expected. You can see that the purple line has gotten closer to the gray line. The gray line is where you expect the inventory to be. The blue line is the most inventory you expect, and the red is the least. And each vertical line is a 1 week. So this is the current week over here on the right, back 1 week, 2 weeks, all the way back to 14 weeks. Moving on to offers accepted, you can see you started off at 73%, which is less offers than you would expect to have had accepted. You crossed over and now you're above, and you can see the increase went from 73% of what you'd expect to 83% of the market, full 10% increase in the percentage of market. And that went from an increase in actual offer count of 1956 to 2156. So we've picked up 200 additional offers at a time of the year where the normal line, the level of expected inventory is basically flat, which is why the percentage of the market of normal has increased. Is normally at a time when the offers accepted is somewhat relatively flat. Yes, there's a low point here and a high point here, but from the starting point to the ending point is relatively flat. If anything, it's down ever so slightly, and yet we're up 200 offers, and that's why the significant growth in the percentage of normal. Looking at days unsold inventory, you went from 43 days to 48 days. And you can see that you went from cooler than normal, above the gray line, to below the gray line. So now you're faster than normal. So even though the market is slower, the 47.5 days that we're at now is a slight bit faster than normally is. You're at 93%, so you're below, and a low number is a fast paced market. And we started off at 105%. Marketing time went from 110, mirroring the days unsold inventory, down to 96. So it also sped up. But the days on market went from 25 to 28. So again, it may not seem possible that you've slowed down by 3 days, but that's a speed up compared to normal. That's because the gray line normally goes from here all the way up to here. And you can see the purple line crossed over about 6 weeks ago, 5 weeks ago. That's why it's important to see what's going on, not only in raw count, but compared to what you'd expect the market to do. The magnitude of price reductions, almost a full % price reduction to slightly over a full % price reduction. This now is less price reductions than normal at 98%. Here it was 12% more. So even though the magnitude of price reductions are essentially the same, you went from larger than normal price reductions, which is why you're on the blue side of the gray line, to slightly less price reductions than normal, which is slightly why you're slightly above the gray line on the red side of the gray line. And the overbidding has actually increased from 6% to 6.5%. This is 0.1% higher than it normally would have been. So normally it would have been at 5.9%. And here it's a full almost 2%. So that would be 4.7% is where you'd expect the number to be, which is why you're now so far above the gray line. You started off right on the gray line, right on normal. Now what we're looking at is 3 of the key indicators, 2 key indicators plus overbidding, just because it's so interesting for people. And this is seller's marketing time. This is something, when you look at the 75th percentile, that sellers and agents really don't have control over, because you don't know what day of the week that offer is going to come in. It may come in the first week, it may come in the second week, it may come in on a Monday, it might come in on a Friday. Anyway, you have a year ago, the blue dotted dashed line down here. The purple line is the current line. So if you look at the greater time on the marketplace, you can see that the market is a little slower this year than it was 1 year ago. But we're starting off on the blue line. We're jumping 4 or 5 weeks at a time. And then we're going to jump at a week at a time when we get back to 13 weeks. So you can see the market going into the right there's the fastest part of the year. Now you're going into the summer slowdown. And starting on August the 2nd, we really haven't changed from August the 2nd. We're just bouncing around, and the solid lines that are coming up right there are the most recent 7 weeks. And you can see in the last 7 weeks, there really hasn't been much of a change. The purple is the slowest out of that last 7 weeks. Basically, it's showing you the market is slowing down, but it typically also slows down because you have to get up, you're going to get up somewhere or close to this dotted line here in a matter of 8-9 weeks, right at the end of the year, beginning, well, middle of January is when the actual peak's going to happen. And I only had January 3rd and January 31st based on jumping the weeks. Now we're doing the same thing. We're looking at the ask price reductions. You can see the purple line is above the blue line. So sellers are actually taking across the board smaller or less frequent price reductions. And since this is the frequency, you can see that the amount of price reduction would have been about 94.5%, and now it's about 95.5%. The vertical separation on here for a good part of the line is about 1% less price reductions from the seller before the offer comes in. Concept is the same as the previous set. The blue data dashed line here is where we were a year ago. The purple is where we are now. 1% less price reduction gives you hotter conditions, which is why you're closer to the blue line up here, which actually represents the least amount of price reduction we ever saw, which was Valentine's Day of 2022. Stepping through, that's the most right there. And then you can see the spring jump up. There's the peak of the market right on April the 5th. And I think it was actually closer to April 19th or something like that. Now you can see you're bouncing. And basically from again around August the 9th, there hasn't really been any change. There's just been bounce in the marketplace. What does that mean going forward? It means I would expect the market to do what it did last year, which is slow down to about the middle of January, turn around and then speed up very rapidly in that first quarter. Moving on and looking at overbidding, this is what the buyers are doing in order to try to secure their property. Here, if you look at it, the purple line and the blue line are right on top of one another. And if anything, the purple line at the very high end, the most overbidding, is higher than it was a year ago. So buyers, the 10% of the buyers that are overbidding the most are overbidding by a greater amount right now than they were a year ago. The bulk of the curve is right on top of it, everyone. But we'll step through and see the same thing where there you are, you're slowing down. There's the bottom of the market on January the 31st. There you're speeding up. There's the peak of the marketplace on May the 3rd. And now you're coming down. And right there about August the 2nd on, there hasn't really been any shift. You're still bouncing. And the lines are right on top of one another. We're going to be going to solid lines pretty soon. We already did right now. And there really hasn't been much of a movement. And now, if anything, the movement's been slightly up the last 3 weeks. But I would call it no movement. I call it just the bounce you're having. And again, I would expect the pattern going from this point forward to be the same, where the next couple of weeks it goes down. You get to about the middle of January and turns around and rapidly goes up. Here's comparing inventory in the 3 individual counties, starting with Santa Clara County in the blue, Alameda County in the gray, and San Mateo County in the orange. All of them are down. But what's also noteworthy is comparing them to where they normally are. Santa Clara County has the least amount of inventory compared to the normal. Alameda County probably is second, and San Mateo County is probably the most normal. If you look at San Mateo County coming back, it's basically right at the level more or less that you'd expect at about 450 active listings. If you look at Alameda County, it's down at around 1,100 active listings. And if you were to pick a time frame for these years here, you'd be somewhere around 1,450. I am jumping over COVID because COVID was a completely abnormal time frame when there was little inventory because of high demand. And Santa Clara County really is not much higher level of inventory than it's been since COVID. So you had 2017, which was a sort of an unusual year in Santa Clara County, where there was sort of a double wave of appreciation. We had normal appreciation early in the year, and then instead of waiting until 2018, we had a second round of appreciation pulled in fairly far into the latter part of 2017. So hot marketplace, COVID hit, hot marketplace, and we've been hotter in Santa Clara County than the other 2 counties ever since COVID. Offers accepted. Here you can see Santa Clara County and Alameda County are right on top of one another. So buying activity is the same with the limited inventory in Santa Clara County compared to Alameda County. That means that the marketplace in Santa Clara County is going to be faster in Santa Clara County than in Alameda County. And looking at the orange line, San Mateo County, down here, you have a slightly lower number of offers accepted. So you expect a slightly slower marketplace than you normally would have. And here is that marketing time measured in days unsold inventory. This is theoretical. It's how long it would take to sell the existing inventory at the existing rate of sales if no new listings came on the marketplace, which will never happen. It also happens if you're in a long-term equilibrium, which also never happens in Silicon Valley. And here is your days unsold inventory. Santa Clara County is the fastest at 30 days. San Mateo County is the second at about 38 days. And I'll point out, if you come back to the beginning part of the graph, San Mateo County is normally faster than Santa Clara. The fact that San Mateo is slower than Santa Clara shows that Santa Clara is the fastest compared to the normal ratio. And Alameda County is the slowest, and it typically is the slowest out of the 3, but there is quite a bit of separation between Santa Clara County at 30 days and Alameda County at something like 44 days. Here's the marketing time, and this is an actual number. This is simply how long is it taking the 3/4 of the sellers to accept offers. And you can see in Santa Clara County here, it's just above 22, probably 23 days. San Mateo County, it's at 30 days. And Alameda County, even though the days unsold inventory was significantly higher, is only at 32 days. So the marketing time varies from 23 to 32 days, 3 to 4 to 5 weeks. Here's the magnitude of price reductions. Alameda County is having the most price reductions, and that's in part because they're on the market for the longest period of time. So I think a fair number of listings in Alameda County are selling after the first seller's price reductions. Santa Clara County has the second most price reductions, and San Mateo County, with the second marketing time, is actually having the least amount of price reductions. People in San Mateo County are holding a little firmer than Santa Clara and a lot firmer than Alameda County. Here's the frequency of price reductions. You can see the frequency in Santa Clara County is the least frequent, which means the average reduction to be greater in Santa Clara than in San Mateo and have fewer people. That means those in Santa Clara that end up doing a price reduction are taking larger price reductions. And the most price reductions is occurring in Alameda County. And again, this is a very tight metric. You're going from 16 to 18%. So not much of a percentage difference. There's only a 2% difference between the fastest county being Santa Clara and the slowest being Alameda County. Here's the magnitude of overbidding. And might sound puzzling to the layperson or just someone looking at it for the first time. The area with the most overbidding is Alameda County, but they have the most price reductions and the longest marketing time. And I think what's happening is they're in a little sweet spot where the buyers tend not to come in with low offers because they don't think they're going to get accepted. They wait until the seller actually reduces their price. The seller overshoots where the real market is, and therefore the buyers are coming in with their overbid. San Mateo County has the least amount of overbidding, and Santa Clara County has the second most. Those two counties are very close together, right about 5.5% overbidding on each side of that. Frequency of overbidding here, Santa Clara County and Alameda County have the exact same amount of overbidding at basically 68%. San Mateo County has a little bit less overbidding at 64% of the sellers getting more than their asking price. Here's the long-term appreciation. Santa Clara County has the highest appreciation rate. It's something approaching, I'll call it about 104%. So you've more than doubled your money in Santa Clara County. San Mateo County and Alameda County are very close together at something like 70% appreciation. And that's since the last 9 months of 2015. So in less than 10 years, you've doubled your money in Santa Clara County, and you've come 3/4 your money in Alameda County and San Mateo County. And if you look at it from an investment point of view, it's actually even better than that because you probably purchased with a 20% down loan. So your rate of return on your down payment is going to be 5 times that if it was an 80% loan. Here's your long-term price appreciation. And I'm noticing I did not move the horizontal line. I forgot to upgrade to this particular slide. So San Mateo County came right back up and is basically right where Santa Clara is. So both Santa Clara and San Mateo County are on this line up here. And then Alameda County is a little bit lower, but you can see all the prices. Well, the prices went up in San Mateo significantly, just like they went down. So that shows you the amount of statistical bounce you can get in a county the size of San Mateo County, which is not a small county. Because the downturn here was fairly significant, and the inverted pricing with San Mateo County being significantly lower than Santa Clara was unusual, but we're back up. So what that basically says is this is a statistical fluctuation for San Mateo County. But it also says that San Mateo and Santa Clara County are getting closer together all through here. And now, even though they're inverted and back close together than they historically are, because historically San Mateo County would be significantly above Santa Clara County. Here's on regular paper, and again, I didn't move the horizontal lines for those that prefer. Here's the estimated payments. So Alameda County has the most affordable. It's going to be in the same order as the cost of the home. And you can see that Santa Clara appears to be just a hair above San Mateo, but I would call them equal in price and equal in monthly payments. Here's looking at the micro market data. This is active inventory. You can see there's a few areas in red, which is a little bit shortage of inventory. Keep in mind, Foster Cities is a very small area and typically somewhere around a dozen properties. So it's very small. And that's one of the reasons I don't do zip code, is I'm trying to get data that's statistically stable versus something to report. And that's why I do micro market areas instead of zip codes. But you can see all the areas, for the most part, are close to normal, because even, the brightest red, if you ignore Foster City, the brightest red is Campbell. It's 2/3 of the inventory you'd expect. So it's missing a third. Looking at offers, here you can see the blue up and down the board, and blue means lax number of offers. The exception here is Foster City. Bright red at 50% more offers accepted than you'd expect. Here's the speed of the marketplace compared to the 10-year median. So it's faster in the heart of Silicon Valley, basically in this section right through here. The rest of the valley is pretty close to normal. Here is days of unsold inventory in raw count. I dropped the comparing it to the 10-year median and just look at raw count. This gives the buyer and the seller some idea of whether they're in a hot marketplace or a cool marketplace. Basically, if you're selling in under 6 weeks, that's somewhat of a hot marketplace. 6 to 11 weeks is a normal pace marketplace, and above 11 weeks is a cool marketplace. And Silicon Valley is typically in a fast-paced marketplace. So buyers really don't have time to make decisions. They have to make their decision before the property they want to buy comes on the marketplace. Looking at marketing time, pretty much normal, and normal is between 3 and 6 weeks. You can see a couple areas are red. Most of the areas are white in color, which are saying they're somewhere in that 3 to 6 weeks. The slowest area is the Half Moon Bay, the coast of San Mateo County, and again, Foster Cities, but that's such a small area. The hottest big area that I am seeing is actually 15 days in Fremont, followed by Milpitas. This northeast area of Santa Clara County, southeast area of Alameda County is sort of the area that's taking the least amount of time to market. Here's ask price adjustments. And again, you can see that it's hard to see the blue. You can see there's more blue over in the index here. I wish I could turn off the background color of the map, but I don't have that ability. The vendor says they use Google Maps and they don't have the ability to turn it off. And I'm going to try to verify that. But anyway, you have more price adjustments than normal, the magnitude, and you can see the amount. So one of the biggest ones I'm seeing is the San Mateo County coast at 2.6%, Saratoga Las Gatos at 2.3%, Oakland at 2.1%. Here's the frequency, so how common is overbidding? And here you sort of have a mix. You have some areas where it's more common with the blue showing up, and some areas where it's less common with the red showing up. So you got a more uniform distribution on the asking price adjustments. Here's the magnitude of overbidding, and here you can see across the board, you pretty much red. The only area that's blue is the expensive areas in San Mateo County. Overbidding, again, very red, high frequency of overbidding. It says overbidding is really common, above 50%. And you can just look down these numbers. A lot of them are around 3/4. The lowest one I'm seeing is in the expensive areas of San Mateo County at 32%. And that's sort of interesting. They actually have one of the highest appreciation rates right now. And I think that's just because of the price of the homes that sold. Here's your appreciation. So these are the areas that have had the most appreciation. You can see Atherton, the expensive areas that we were just talking about, at 114%. And some of the areas that have the least amount of price appreciation is Redwood City, which is a little surprising, and Foster City, both right around 40% appreciation for 10 years. Here's the sold price, and instead of just following the median, which is the middle number, I sandwich it by including the 10 percentile, the cheapest you'd expect to see, and the 90 percentile, the most you'd expect. So you can see the price range of the homes you'd expect to see. And this distribution that you see for Silicon Valley is sort of the typical, where going from the 10% to 90 percentile is only about $730,000, but going from the median to the 90 percentile is almost $2 million. So when you're in the lower price range, a little bit more money gets you a lot more house. When you're up in that upper price range, it starts to take a lot of money to make a difference in the house. Here's a table summary. You can pick the geographical area you're interested in on the left, or you come over here and pick the payment you're looking for, or the total purchase price you're looking for, and then read across and see the market conditions. The yellow highlights are sort of the leading indicators. The slight highlight is an indicator, but not that much of a leading indicator. The orange are lagging indicators because you need sold price. And again, the brighter, the darker one is the more significant than the frequency. The frequency tends to take longer to affect a change than the magnitude of overbidding. Here's the raw count for Santa Clara County, San Mateo, or Alameda County, or Silicon Valley as a whole. I do want to point out the lack of new listings coming on the marketplace, basically down around 8.5%. That's significant because that means that the drop from 6 weeks ago to this week is about 25% of the marketplace. And the reason I'm saying 25% of the marketplace is I keep 80% of the data is the same. So the data from 2, 3, 4, and 5 weeks ago is the same data. So the only data I'm changing is the 6 weeks and the first week. So if you assume it's uniformly distributed, which is not a good assumption, that each one is about 20%. So round it up, bump it up, and say that 6 weeks ago was 25%, Now you're losing 8% overall. That means you're losing 1/3 of that 25%, because 1/3 of 25% is the 8% drop. So we're getting about 2/3 of the new listings this week that we did about 6 weeks ago. Don't know if that's clear or not. Active inventory and these numbers being exactly the same, I think something went wrong with my micro. I just don't believe that number, those two numbers. I think there's probably a problem here. I do believe the active inventory for Santa Clara County is up, but I need to check those. Here's the year of volume of sale, and it's becoming less significant. In fact, this 2022 was the least amount of offers accepted out of the last 25 years. 2023 was second at 1746, exactly equaling the volume back in 2007. So the three lowest years are 2007 at 1746, 2023 at 1746, and the lowest year, 2022, at 1741. This year we are 2158, so you're 24% above the lowest level of number of offers. We have been talking about Silicon Valley real estate market analytics for November 2nd. We will be going on to the greater Bay Area, but first, to get to the archive on YouTube, you type in the blue URL or you type in the shorter green root URL. To join the presentation live Saturday morning at 9 a.m., you type in the green root URL and the year 2024. Passcode is here if you need it. The handouts, which are available, there's 67 pages, I believe. It's the green root URL plus the letter H for handout, 2024-1102 for today's date. And any specific past episode is the green root URL with the year, month, day code without the letter H. I'm Richard Calhoun, real estate broker with Creekside Realty. My contact information is here for you. I represent buyers or sellers here in Silicon Valley. We're willing to talk to you about your real estate situation. Please consider liking every video you watch and subscribing once. Moving on to the greater Bay Area. The greater Bay Area is broken into 5 regions, the first being Silicon Valley that we've talked about at length. The next is San Francisco and Marin that I refer to as the cities. North Bay, which is Sonoma, Napa, Solano, Contra Costa. Central Valley, which is San Joaquin and Sacramento, and the Central Coast, which is Santa Cruz and Monterey. Here is the inventory for those 5 regions. You got North Bay and Central Valley, they're clustered right at 3,000. You have Silicon Valley, which is down around 2,300. You have the Central Coast and the cities that are close together around about 700 active inventory. The big takeaway here is the lack of inventory in the Central Valley and in the North Bay is greater than the lack of inventory anywhere else on a percentage basis. You have those 2 areas up here somewhere around 4,500 or so. They're at 3,000, so they're missing a third of the marketplace. Silicon Valley is probably somewhere around 3,000, and it's at 2,300, so it's only missing a little over 20%, 25%. And I'm not going to do the math real quick, but the cities looks pretty close, and I would say it's then followed by the Central Coast and the cities. You have to ignore the stuff right after the pandemic because there was just a lack of inventory, but it really hasn't come back. In fact, the lack of inventory in 2021 and 2022 is almost as much as the current lack of inventory. We're up a little bit, but not dramatically up. Here's the number of offers accepted. The Silicon Valley has the most offers, even though there were areas that had greater inventory. In fact, the areas that had greater inventory were the North Bay and the Central Valley. They have lower number of offers, so they're clearly a much slower marketplace because they have more inventory and fewer sales. So Silicon Valley has the greatest turnover rate out of all of them. And here you can see Silicon Valley does have the greatest turnover rate. You can see the days unsold inventory, which is the turnover rate, is dropping like a lead balloon. You've gone down probably close to 20%, it looks like, across the board. So maybe Silicon Valley has decreased the least because it's gone from about 47 down to about 36. So it's only dropped about 11. It's dropped about 25%. Or if you take something like the cities, it looks like it's dropped the most. It's dropped from 81 down to 43. That's approaching a drop of 50%, not quite there, probably something like 40% of the market. And that's the speed of the marketplace. Now you're measuring time for 75% of the sellers to sell. So 3/4 of the sellers to sell. These are actually increasing, except for, well, the Central Valley is rolled over and gone down, and the Central Coast has gone down. The other 3 are going up, but in general, the trend has been up. And, it's sort of interesting that the speed of the marketplace, the turnover ratio is faster, but the marketing time is increasing. That suggests to me that what we're doing is we're starting to sell some of the properties that have been on the market for a long period of time as the market heats up. Here's the ask price reductions. So the Central Coast is taking the most price reductions, and they're reducing their own list price. These are sellers by about 2.6%. North Bay is next at just shy of, call it 1.9%. Then you have the Central Valley at 1.7%. You have the cities at 1.5%, and Silicon Valley at about just over 1%, about 1.25% price reductions. And these are price reductions that the sellers are taking to trigger in the offer. Now, granted, that sellers aren't taking a 1.25% price reduction. It's some number around 15% of the sellers are taking 10% price reductions. Here's the frequency of the price reductions. Silicon Valley has the least amount by quite a bit. At only about 17% of the sellers doing price reductions, followed by the cities at 23%. Then you jump all the way up to North Bay and you're at 31%, Central Coast at 34%, and the area with the most price reductions, Central Valley at about 35.5% of the sellers taking a price reduction on their ask price. This is the buyer overbidding, so this is flipping around and seeing what the buyers are doing. So the cities has the most overbidding at about 7.25%, next to Silicon Valley at about 6.5% overbidding. Then you jump all the way down to the North Bay at about 0.75% over ask price. Then you're under. Central Valley is about 0.25% below the seller's ask price. And in the Central Coast area, you're about 1.5% below the seller's ask prices, where the offer prices are getting settled out at. This is the frequency of overbidding. Most overbidding in Silicon Valley at about 68%. Cities is next at 62%. So 62% is lower. The San Francisco cities area has less overbidding, but it had a higher over average overbid. So the amount of overbidding, the magnitude of overbidding in the cities is much greater than it is in Silicon Valley. Then you go down to North Bay at about 42% of the sellers get more than their ask price. The Central Valley, which was slightly under, but still 38% of the sellers are getting overbid. Then you jump down to the Central Coast, which was almost a 2% price reduction when the offers come in. Still almost 32% of the sellers are getting more than their ask price in that area. Here's the total appreciation. The cities area has by far the least amount of appreciation. Look at the skyrocketing appreciation in the Central Coast. This happens, you can see big run-ups in the Central Coast. It depends on whether you're selling inland properties along 101 corridor, or if you're selling properties along the coast with views. But dramatic increase in the price just in the last week in the Central Coast area based on what has sold. The area besides that has the highest appreciation, and I think more long-term, would be the Central Valley, the areas where people are now migrating to because they don't have to go to work as much. And these numbers may change as companies start to force more and more back to work. And here's Silicon Valley. It's pulled down because remember, Santa Clara County was something like 102% or 104% appreciation. But when you bring in Alameda County and San Mateo County, the three counties together are about 84% appreciation since 2015. North Bay is down around 66% appreciation. And the lowest, as I said, was San Francisco. The cities had 48% appreciation, which is still good appreciation for the last 10 years, especially when you probably purchased a property leveraged out with an 80% loan or something approaching that. Here are the median sold prices. You can see the sold price jumped $100,000, which is basically a 10% jump in 1 week, which is pretty hard to do when, 80% of the data is the same. That means that the new data for the last week is almost 50% higher than the data from 6 weeks ago. The median from 6 weeks ago to this week is basically 50% higher than it was a week ago to get this 10% increase. And that's part of the reason why it's important, in my opinion, to cover more than 1 week. Yeah, I do understand that some people cover weekly data, but then you get a lot of noise versus changes in the marketplace. The disadvantage of covering a 5-week period of time is there's a lag time in the data, but by reporting the data every week instead of once a month, you get rid of a lot of that lag data at the time. Here's your estimated payments. The interest rates went up a little bit, so you're seeing payments across the board going up, and a steeper increase in the Central Coast, where also the prices went up based on the median. Here are the raw numbers across the top for whatever metric you're interested in, and then the different counties along the side. I also have Silicon Valley and the Bay Area. Although I professionally believe the Bay Area data is a garbage number because of the wide variation and how differently the market behaves within the 9 counties that touch the Bay. But that's what the media focuses on, so I want to report that data just so you have something to compare to. And here's the index that I use that you can jump to whatever chapter on YouTube that you find most valuable for what you're trying to do. Chapter number 1 And it's just in order: graph 1, graph 2, 3, 4, 6, 9, 12. So the first chapter is active inventory, the raw number of the current data week compared to the active inventory for the past 10 years, median. Same with offers, same with DUI, and I go back to 2014. So you have a comparison from 2014 through January 1st of 2023. It's on a condensed scale. Then 2023 and the current year are exploded out horizontally on the date line so you can see better what the current trends are. The second chapter goes over the current individual metrics. So I go through each metric and I simply show the metric in the purple compared to the median for that metric for the past 10 years showed in the thin black line. And then I showed the extremes, the red line, the hottest marketplace you'd expect, and the blue being the coolest marketplace you'd expect. And the data can go higher than the coolest or lower than the hottest, because the hottest and coolest is just defined based on either the 10 or the 90 percentile. The next metric is the same key indicators, 5 key indicators plus overbidding, because it's of such interest, for the past 14 weeks, basically a quarter with the 1 extra week on it. And I show the raw count of 14 weeks ago and the percentage of normal compared to the current raw count and percentage of normal on the right-hand side. So you can see how the market's behaving in the recent periods of the last 14 weeks compared to where it normally compares to. Then we look at 3 distributions. The 3 distributions I dive into are days on market, which is the time that it takes 3/4 of the sellers to sell their property. And this simply looks at each listing and does distribution. I start off by jumping either 5 weeks or 4 weeks at a time. And then when I get back to 13 weeks ago, which is 3 months ago, I jump from simulating monthly data to doing every single week data. So there's 13 data points coming forward so you can see what's happened recently. And the purpose of all 3 of these distributions is so you can anticipate what direction you expect the market to do. First, you can see the extremes, the full distribution of the key indicator, plus you can see the direction the market's most likely to move. The next chapter is the seller's expectation, and I measure that based on how much the sellers have had to reduce their ask price compared to their original ask price. So this is sellers' expectations of the market versus the market reality. Sometimes people think the market's been on fire and it's going to continue to go on fire, and the market's turned and is cooling off. And that's when sellers' expectations tend to be out of line the most. This industry is set up to tend to look in the rearview mirror for pricing currently. And that's part of the reason for looking at this data in detail, is to try to give you an idea what pricing is actually today instead of in the mirror. And then because of the high interest, overbidding. And this shows you when you're interested in a property, if you really want to get a property and you say it's one of the top 10%, you may want to come over here and look at the amount of overbidding. Now, you also want to do other things like look at the market value. You want to look at how badly you want the property. And also, in general, buyers tend to migrate to round numbers. So you want to go in my opinion, slightly over the round number that you anticipate other buyers are going to be at if you really want the property. If you don't really want the property and you're looking for a good value, you might want to be at the lower end of this overbidding curve. And it also depends on where the seller's ask price is, which is almost irrelevant because it's the buyers that are making the payments and they determine how high they are or not willing to offer on a particular property. Then we move on to comparing the metrics, all the metrics compared to the 3 counties. So I split out Silicon Valley into the 3 counties, which are Santa Clara County, Alameda County, and San Mateo County, and step through. And the goal here is, one, to give you, with Silicon Valley, a global view of what the market's doing. By breaking it down into each county, you can see what's more likely happening in your neck of the Silicon Valley. And in the terms of breaking it down, the next chapter is the micro-market areas, where I look through each metric, but instead of doing it at the county level, I do it at the micro-market area. And I have broken Silicon Valley into 20 micro-market areas. And I try to put similar properties together so you're seeing what the market's doing. I don't focus on an individual zip code because there's not enough data points in that zip code to understand what the market's really doing. And then I do a table summarizing that information, and this allows you to pick the geographical area you're looking in, or the price, the monthly mortgage payment, or the loan qualifications, and then look across, find what areas you're interested in, and look and see what kind of the market conditions are going to be in that particular area. The next chapter, chapter 10, shows the actual raw data. I do Silicon Valley as a whole, then Santa Clara County, San Mateo County, and Alameda County, all the different metrics. Then I put this slide on, and it's becoming less important. It was important because we had been having one of the lowest years, and for the most part, the lowest year. We're now up to being the 8th slowest out of the last 10, and the 22nd slowest out of the last 25. Currently, 2022, 2023, and 2007 have less offers than the current year. And here's the how to participate live in presentation that we just went over with before this one. Then we break into the Greater Bay Area. Then we look at metrics for the Greater Bay Area, and then the raw count for the Greater Bay